Are you serious about planning a successful business exit? From Angel to Exit is your go-to resource. Subscribe to our newsletter at eckfeldt.com/podcast for even more valuable insights. And to get personalized guidance, take our free exit readiness assessment. It's just 24 questions, and it will give you a clear picture of your exit readiness. Find the assessment at eckfeldt.com/exit. Submit your results, and we'll schedule a free follow-up call to discuss your specific situation and the best way to maximize your valuation and ensure a successful transaction. Now, back to the episode. Welcome, everyone. This is From Angel to Exit. I'm Bruce Eckfeldt. I'm your host. Our guest today, Clay Risher. He is Managing Director at True North Capital Partners. We're going to talk to him about his experience working with many businesses. He's had a lot of kind of personal background in the business space, and obviously now in the M&A space is working with several companies that have a lot of insight to different markets, different industries. Really talking to him about what that whole process is like. One thing I always tell founders is, this may be your only deal as a founder when you exit. For the other side of the table, oftentimes it's a Tuesday. They're going to be running many processes, many transactions. It's a very asymmetric process at times. And I'm really hoping Clay can give us some insights on what the other side is like or what you need to anticipate and just some learnings having from someone who's been through the process more than once. So with all that, Clay, welcome to the program.
Bruce, thanks a lot. It's a pleasure to be here. I've always enjoyed having conversations with you. So thank you for having me on. I appreciate it.
Yeah, no, it's great to have you. Before we kind of dive into the world of M&A and exits and all the learnings there, I would love to get a little personal background. I mean, give us kind of your personal story, your professional story, like what got you into business, what was the background there?
Yeah, so I'll try to make it a bridge because of my age. I have to talk in, sound bites. So, basically, born a Texan in Austin, kind of grew up with a very upwardly mobile parents. My dad was a pretty ambitious guy. When he got his MBA at University of Texas Austin, when most people didn't know what that was, and so he ended up matriculating through his career through IBM and some other large corporations before he finally took over as CEO of a company called Eckfeldt in Raleigh. And so I always had this sort of business mind from my dad. It was like having a professional football coach as a dad, right? I mean, and so it was always great. But I always had a creative side, and I think that came from my mom. And she's a writer. She's a Wellesley College grad, and two of the smartest people I've ever met. We all have caveats as family members, right? So,
biases in different directions.
But both were really good at kind of where they, what they wanted to do with their lives and how they wanted to go about it. And so, I think it shaped me to have kind of utilize both sides of my brain. Where I think a lot of folks that I meet in business today are kind of one side of the brain or the other, right? And so. So long story short, got into corporate sales, got into investment banking, which is where I'm at today. Kind of a long way around. I worked in corporate America, branched off, started my own businesses, exited one, got back into corporate. A long story. I think because, my wife and I don't have any children, and so we've had some flexibility that most people don't, right? And so, we're bummed about that, but we have a bunch of nieces and nephews, and it's kind of nice that they all have a return policy on them too. So we don't get
almost the best of both worlds.
We just spoil them and then give them back, and so, but it's allowed me to kind of take chances in my career and do different things. I took time out to write a novel. I had a New York City literary agent. I was favorably reviewed by Kirkus. I mean, so, for good or for bad, I've been able to take those swings. And so that's kind of my background. I guess if you were to label it one thing, it's just be sort of a lifelong learner and a lifelong curious person. And, every day is a new opportunity to learn something new or meet somebody new that could really have an impact. So I don't know.
I'm curious what I mean, seeing your father kind of in the executive role and being in business, like what were your takeaways on it? Was this like, oh, this is absolutely what I want to do? Was this, hey, there's some learnings here. Maybe I want to do something differently. Were the things that were not appealing, kind of given that exposure when you were younger?
Yeah, I mean, my dad lived for business, and I think he lived for business because his mother was an entrepreneur in the 50s when, women just weren't entrepreneurs. And so she and my grandfather owned 3 furniture stores in the Dallas area for years. And it's funny because I think my dad, he excelled at sports. He had 200 athletic scholarships to everywhere from Alabama to Penn State and to play football. And I think he was so good at business and athletics because the alternatives for my grandmother, who was Finnish and very, very strict, was like, you either really excel as a student athlete or you come work at the furniture store. And so he was like, okay, I'll get straight A's and I'll get all these scholarships because I'm never going back to that thing. So,
highly motivated to not.
He learned he worked in the store and that impacted him. And I think he was just really driven I think he was a guy who was driven to lead. And I think he was a guy who was driven to constantly perform better the next day than he did the day before. And so, I got a letter the other day from an employee of his company that I worked in 20 years ago. And this guy said, I just want to take some time to tell you how much your dad meant to me and, how he,
Nice.
and I get that a lot still. He's passed in 2019 and it's, it's hard because he had a tremendous influence on me, but he and I are just kind of different people. You know what I mean? He's like kind of balls to the wall and all out. He always used to say, you got to play hurt. You got to play hurt in this league. And he just his body was beat up at the end of it. He gave everything. He left it all on the field. And I was kind of like, I'm a little bit more conservative, and I'm a little bit more bookish. At the end of the day, I'm a little less. Gregarious person, and so I just figured, I'd take the best of what he did and try to meld it into my pot, and then the things that I probably wouldn't excel in or didn't really have an interest in excelling in, I kind of left it on the wayside. But he was a tremendous influence and a tremendous man, and they just don't make them like that anymore.
Yeah, it is just a different generation in many respects. Yeah. How so? When did you first kind of get into the M&A process or go through kind of an actual transaction, either directly or indirectly? I'm kind of curious when that first came up for you.
It's funny because it happened really early in my career, but I was the guy who tested like 12th grade, reading when I was in like 7th grade and remedial math, and so I was always told, you're not going to be good at banking. You're not going to be good at Wall Street. And so go figure something out. So I first kind of got exposure to it when we took my dad's company public in '98. We took it public on NASDAQ, and I got to, he'd come back from the road shows and I'd be out selling our boxes, but I'm like, God, that seems a shitload more interesting than me going out and selling stuff. And so I got exposure to it, but I was always kind of like, well, I'm not going to be good at that, so I'll just stay away from it. So I went and started a few companies, but always had the itch, and I tried to get into Wachovia Bank's investment banking program way back when I was much younger, and I think my dad was on the board, and so they had an anti-nepotism clause, and so they were like out. I started a marketing firm and turned that around, and we built it up to a couple $1 million, and I sold it back to my partners, and I figured, what's next? And so then I got into consulting, and I was with RSM, which is kind of the under the big 4 consulting and accounting firms, it's number 5, or that's where they bill themselves. Which I wasn't marketing them, or I wouldn't have built it like that. But we're number 5. But my clients at that point in time were hedge funds, investment banks, private equity, and I started to just say, this seems interesting. Number one, number two, these people all put their pants on one leg at a time. So I get it. And so I just started gravitating towards that. And I figured, I don't care whether you're a PE firm, whether you're an investment bank, or whether you're whatever, you need somebody with some sales acumen. And I kind of brought a lifelong of sales to the investment banking firm that I'm at. I actually went to them just because they were a client. I said, I'm about to launch this kind of search, and I'd really like to become a business developer, private equity firm. This was some years ago, or investment bank or something. And then, Fred Rossetti, who's one of the founding partners at True North Capital Partners, which is the investment bank I'm at today, said, well, we're looking. And I said, okay, cool. Well, then I won't have to go look far. And so, I got into True North about 6 years ago, and got my licenses, got my 79, my 63, and I've been working international M&A with True North, lower middle market M&A for the last 6 years.
Let's do just for the audience, because I assume everyone knows everything, and they often don't. Just define investment banking for me, right? Like when we talk about what an investment banker does, and I always kind of joke, right? It has really very little to do with investments or banking, but we call it investment banking. So, like, give us kind of like from your point of view, like what is really your role and what is your day-to-day activity around?
Yeah, I mean, the other bankers in my firm don't want to hear me say this, and so I'll give you two versions of what it is. You're a trusted advisor to CEOs, founders, in helping manage every aspect of a sale or a buy side mandate. And so you have to know valuations. You have to know different vertical markets. You have to be really quick study. But you're right. I don't know how many times I get approached, and it's like, well, can we sell something to your portfolio companies? I'm like, we're just a glorified real estate office. We have a product which is our client's business, and we know the investors that we can take that business to. Pretty much, it's a lot of frog kissing. I get probably a kid a week coming into their senior year of school saying, all I want to do is investment banking, and tell me how to get in here, and can you sponsor me? And I said, well, what do you think investment banking is? Because it's a lot of kissing frogs. It's a lot of sitting in a blind for hours on end and not seeing any 20-point buck anytime soon, and so it's a lot of highs and a lot of lows, and so but it's exciting, and every day is different, and I guess that's why I guess to define it is just it's an interesting spot to work.
And you mentioned sort of lower middle market, and you mentioned industries. Do you have a particular area of focus, or what areas or types of situations, types of companies are you primarily focused on?
Great question. The firm we're generalists, but I've kind of, for whatever sets of reasons, gotten pretty good at consumer products. I'm probably, with the exception of one other banker at the firm, probably the resident TMT banker, because a lot of our guys are like smokestack value businesses, and I don't know how to put that eloquently. Anyway, it's just not there. It's not what they've been doing for the last 20 years. AI, SaaS, all that stuff. And so, and then, by virtue of working with Japan's largest trading firms as our clients, I've been exposed to industries I didn't even know existed before I got pulled into the mandate. Cementitious materials. I didn't realize that all the asphalt on the highways is made out of fly ash coming out of steel mills, and so that goes into that. There's just all sorts of stuff you learn. The building products industry I've gotten pretty well versed in, and I won't bore you, but all sorts of different stuff.
Yeah, I must say, I mean, personally, one of the things I love about what I do and working with all these founders, and it's just you learn about these industries and these markets, and it's like, yeah, well, someone's got to make that thing, right?
Right.
It's like you just don't, and you realize it's like a $50 million business. And it's like, it's just fascinating to see, really what drives our economy, and it is made up of thousands and thousands and thousands of these mid-market, lower mid-market businesses. Is really the huge part of the market here.
It is amazing, and you really get a macro economical view of things, and a global view, and it's wild. I mean, there's this, you'll never learn enough. You know what I mean?
Yeah, yeah. So we mentioned, or you were kind of mentioning, kind of the buy side or sell side mandates and side of the market. Give me a sense of like how are those different from an M&A point of view, or from a M&A advisor or kind of investment banker point of view, and where has your focus been, and why?
I've kind of shaken out as more of a buy side banker, and so for the crowd's information, is buy side is when we'll get hired by a large corporation or a private equity firm to go out and do a search for a company. They either want to create a platform investment, which is the sort of first investment in an industry, and or go find add-ons for that, right? And so you're representing the buyer on the buy side, right? And conversely, on the sell side, you're representing the seller of the business, and so that's a whole nother kind of different methodology of doing road shows, for lack of a better term, and doing all the analysis to come up with a valuation, and so I hope I explained that eloquently and coherently.
I think it's interesting because I think we, a lot of founders, right? They're talking to the sell side M&A folks, right? The investment bankers, right? Like, I've got a business, I want to sell it. I find a banker who's going to, make a market for it. We're going to find potential buyers. They're going to help navigate that process. But the flip side is true as well. It's like, okay, yeah, I have capital basically, or equity capital that I want to deploy, and I want to, rather than trying to scale my business internally, I think we want to do an acquisition. What I guess I'm curious in terms of the buy side, what generally are the motivating factors that make companies want to actually go out and do acquisitions, right? Like, how do you kind of assess, or what are the driving forces for the buyer?
Well, it's different because if you're talking about a strategic acquirer, like a large corporation who's vertically integrated, say some of our Japanese firms, $100 billion, 150-year-old firms, Warren Buffett, Berkshire Hathaway owns 10% of one of our biggest Japanese clients, and so they're into everything, right? But they don't want to. They're unlike a private equity investor, or what we call a financial sponsor. Strategics are really wanting to focus on finding good businesses and making them better. Financials and private equity are generally looking for distressed companies or situations that are heretofore a good company, but they can improve. And so they're looking for a bargain. They're looking to get something at a discount. And conversely, very few private equity or strategic buyers want to pay much of a premium. I'll give you an example. We just came out of data centers are so hot right now, and sort of the digitization of the legacy grid in the world, right? Hydro and all the things that drive electricity. Specifically, data center, what they call MROs, which are maintenance repair organizations, which are third-party organizations that come in and clean out whatever needs to be cleaned out, maintained, upgraded, and so the big data room companies don't want to deal with that. It's just a service they outsource. So these guys are trading at 20 times, 25 times EBITDA, which is outrageous, right? I mean, usually, I don't want to minimize it, but pretty much any business we'll look at is generally trading between 6 and 9x EBITDA. I mean, it is what it is. And so, so those kind of things, drive buy sides. basically wanted to add on, build, maintain, and grow an existing platform to make it larger. And in the context of strategic buyers, they generally buy, hold forever, right? Whereas private equity will buy, fix, and or hold, and then sell within a 5 to 70 year time frame.
Yeah. My general kind of experience and impression is that the private equity, the financial side, it's more like a game of math, right? Like they're basically looking at the financials and saying, okay, well, how capital efficient is this? If I put more money in it, or we, figure out how to right size some of these things, or develop a better strategy, we could scale it, and that scaling can produce additional net margin contribution. Like there's a financial rationale to scaling the company that's going to either generate cash or generate value that they can flip and realize on a second exit or a second transaction. Whereas the strategics, I find it tends to be a little bit more 1 + 1 = 3 kind of thinking, where it's like, hey, we've got these products and services, you've got these customers, maybe we could figure out a way to kind of leverage that, or there's a geography, or there's an asset, or there's an IP. Like it tends to be a little bit more nuanced. And I'm always just kind of curious, particularly on the buy side advisors, like how you figure out what those drivers are. It's like, okay, well, this company is looking for this type of assets or this kind of situation because it's going to plug into their bigger strategy, and then how you kind of evaluate deals, because it feels much more kind of wizardry. Yeah. It's like, how do I see where the opportunity is, rather than just like send me your financials and I'll run some numbers and decide whether we're going to buy you or not.
Yeah, so it really goes upstream to once we've identified a target industry we want to go after. These large strategics that I work with have vast corporate finance departments, and they have people in there munging on numbers all day long, or munging on lists and databases and all the rest of it. And then our folks, our analysts, will also go to town working in cahoots with our partners to come up with sort of a master list between the corporate finance group of our clients and our analysts and partners, putting together what we think are good targets. And we base that on a lot of criteria that nowadays you just check off within the data with Cap IQ or whatever it is that you're looking through. And it'll give you a reasonable facsimile of some companies that might be a fit. The bigger, it's not really a problem, it's just a known, is that when you're dealing with private companies, which predominantly we are, Cap IQ will say they were $100 million company. You'll make a phone call in there and it'll be like, oh yeah, we just did $5 million last year, right? And so, these are the things. And then so what I do is take the finalized lists, and I just start smiling and dialing, building relationships, and trying to, talk to founders, owners, operators about what their appetite is for wanting to sell. Yeah. Is it more of a recap? Keep a few people in. Send a few people to retirement. And what's the long-term goals? And so. I don't love the cold calling aspect of it, but we're kind of warm calling. But I do like the kind of psychological connection you make with founders, because I've been one, right? And so I get it. It's kind of lonely. And when somebody comes around and says, I've walked in your shoes and I understand it. And it's not easy. People are like, you're good at your job. You're really good at your job. It's almost like they're sort of inferring that it's simple, but it's like it's the sum total of X amount of years getting my ass kicked and learning life's lessons to be able to talk to a 40, 50, 60-year-old founder who may have never even considered selling their company until we start talking. You know what I mean?
I'm kind of curious what those initial conversations are like, or what are you looking for in terms of, you've identified, something on paper that looks interesting, you've got the contact, you make a call, or you connected with the founder. Like, what is it what is it you're actually looking for in those early conversations?
It's a great question. I think just synergy, you know your clients, the kind of personalities that are probably going to gel if there is an acquisition. I can go from a morning full of hang-ups, and this kills me because people I think are so ill-informed that because I'm like Willy Wonka calling in with a golden ticket, and it's just people they're so haggard or they don't get it. I'm talking about multi-billion-dollar companies that are going to be a cash buyer or cash in equity, and then you get another bite of the apple. I'm like, why would you hang up on that opportunity? That's a once in a lifetime deal. But anyway, most of the time people will call me back, and it just starts with a simple conversation, and I just try to listen and add value where I can. And it's so far from being, like a manipulator or, I go to each conversation. It's cliche to kind of meet that person where they are, right? I've done my research. I've looked them up on LinkedIn. I've seen if I have people in common. I spend a lot of time on their sites trying to understand their business before I even pick up the phone. And so the conversation is just like a kind of a first date, Yeah. And then you hope it goes forward from there. And, but pretty much the data we get on these private companies are far from reality.
Yeah. You need to get
what's going on.
Real information. So assuming a founder is, interested in talking, right? They're like, yeah, no, I'm curious to learn more, those kind of, kind of walk me through a little bit of the phases that you go through in terms of evaluating, kind of deciding, we have to answer these things, and if that looks good, then we go to this step, and then walk me through a little bit of your process.
Yeah, I mean, it's, you want to weave a little science and a little, and a little art into every conversation. And so you want to get to know the person a little bit better first. Then I think you're going to ask some key metrics, and they may not be willing to divulge unless we're under NDA, right? And that's fine. And you just say it as innocuously as possible. Like, if you don't want to talk about this right now, that's fine. And then it's kind of like those first phone calls are generally like, I've given you a lot to think about. I usually have kind of a thought process of how best and most efficiently to describe my client, right? It is in the instance of my one client, it's very easy to get people interested once you say Warren Buffett and Berkshire Hathaway own 10% of the company, right? Because then they're like, whoa, wait a minute, who?
This is serious, yeah.
And so, but you just have to find those kind of hooks, and then you can have those secondary conversations about, hey, how many employees do you have? How was it last year? A couple years back, it was a big question about how was COVID? Did you take, did you take was it PPP? PPE?
No, well, PPE is the stuff we wore.
PPP was the stuff we took.
Okay. Yeah, exactly. SBA loan or whatever the
EIDL, all that stuff.
Loans. Yeah.
And so, and then you kind of, and what your client's looking for because you've already discussed it. They're looking to buy a $250 million, $50 to $250 million enterprise value deal. They're looking to, in this geography, that's very relevant. They're looking for a nice customer spread, no customer concentration, right? And kind of the executive management team. What do they look like? And so, it's not rocket science, but I think it's all in the delivery.
Yeah. What, if I'm, I do a lot of advising and founders on the sell side, one of the things we say is we got to ready to market, right? Like, don't take an unsolicited offer, right? Like, let's figure out, how do we create some competitive sense here, right? Like, we want to get a couple people interested so that we can kind of understand really where the numbers should be, and we can play things off each other to some extent. Like, how do you sort of navigate, or how do you advise potential buyers around this when they are kind of like, hey, I'm interested, but I don't have any other competitive bids? Like, are you looking to kind of make these quick deals where, buyers are looking to sell before they really kind of go to market, before they've created a competitive, landscape? Like, how do you navigate that process?
It's deal by deal, and it's a great question because ideally what we want are unsponsored, founder-led, businesses that haven't gone to market yet, right? And then sort of the next phase, and some of our clients, our largest buy-side clients, just say, look, don't even get me involved in a PE-owned company, even though it may be time for them to exit, right? And so, so you're really looking for that diamond in the rough. Competition's ubiquitous. Some owners, like I talked to a guy, had a General Electric contracting company for mid-Atlantic data centers. This guy was like, I started building this business, QV ready since week one, right? So he runs his books like a private equity firm runs their books, right? He knows exactly what his free cash flows are at the end of the month, and what his customer concentration is, and what's forecasted. And then you've got the owner that's like, it's maybe a lifestyle business, or it's a couple generations down, and they're not as focused as grandpa was, right? And the Aspen ski vacations, end up on the list of ad backs and all the rest of it. So it just depends, I mean, you ideally want to get them unsponsored and not in the middle of a process,
Yeah. I'm curious. Tell me more about what, like, the thing is that either make a deal go well or make the deal either complicated or potentially even sabotage. I mean, you mentioned, having the books, in good order and things like that. You also mentioned the whole, I've got a whole bunch of expenses here that are really personal expenses going through the company. What are kind of the deal accelerators and deal detractors that you've seen in the work that you've done?
Yeah. So, I'll give you an example. Small little manufacturing company in the Southeast, I'll put it that way, because it's a live deal. There's some state and local tax issues. I believe it was an act of omission, not commission, to not file the tax forms in certain states. Their products are sold. But that kind of stuff just sets off red flags, right? And so you may not want to have outside accounting, but unless you're a CPA also running your business, I would highly recommend giving that part of your business over to the experts, right? So that they're building your business with you foundationally, so that it's stuff like that. It's like I said, are the executive leaders, is this a piggy bank for them? Is it a lifestyle piggy bank for them, or is it a going concern that's profitable? And always want to be looking at your EBITDA margins. I think anything 15 to 25 and beyond % are always good numbers by acquirers. Like that. Customer concentration. You cannot come to a buyer and say, yeah, I got $100 million business and 99 million of it comes from Exxon, right? I mean,
what are the, so what other? Does this vary a little bit by industry or situation? Because on the advisory side, like it's tough. Like we certainly run into these a lot of times under $50 million, right? They've got big clients sometimes, right? And sometimes it's 10, 20, 30% of the revenue. And it's not like I'm going to tell somebody, well, stop doing business with them and reduce your revenues by $10 million, right? Like we can kind of scale and we can try to figure out how to diversify, but there's always a little bit of this, like, okay, well, I can grow. It's easy to grow existing accounts, right? Like, where's my trade-off, or where do you see sort of the trade-off in terms of, well, I can scale the business, I can add more revenue to it. What's the trade-off with that concentration of revenue, and where do you really kind of see some breakpoints in terms of really when it becomes an issue?
I think, as a percentage, do you mean, Bruce? I'm sorry, as a percentage of like customer concentration?
Yeah. So like as a percent, like when does the flag really go up in terms of, and maybe it's by industry or type of business, but like when you see a client concentration.
Yeah, I think when you're looking in that 30 to 50%, you're probably starting to get the little buzzers heating up, like in the submarine. It's not quite red, but it's you got to get go wake up your salespeople. And I'm a former salespeople, salesperson, so I can say that. But go wake up your sales and marketing people and get them working on new client acquisition, basically.
Yeah, yeah. Do you look at? I'm always curious if you look at kind of industry concentration versus customer concentration. Like, because I've run into a couple of cases where like I don't have no customers more than 10%. But we look at 80% of the revenue. It's all a really specific, highly related industry or situation. So it's like, I don't have an individual client concentration issue, but 80% of our revenue is coming to this area. And if, economic downturn, interest rates change or something like that, it's going to affect everyone. How do you look at industry concentration?
It's a great question. I mean, I think it just depends. I mean, like some businesses are just built to support, one or two industries, right? And so, but I think it's a very good question. I think that's why you want to perhaps position yourself for sale as a tine in the fork of a larger organization that doesn't capture that vertical, right? It's a little bit more research, a little bit more understanding. But if there's no way to diversify, I think you have to look at that kind of an exit. I think you're doing the one thing this one big company isn't doing, right?
Yeah.
So does that make sense?
You can kind of complete the puzzle. Like you're the missing corner piece that they haven't been able to find. And while you may be specific, in the context of the buyer, it may be actually a diversification strategy.
Yeah, I mean, I think I'll give you an example. Again, go back to grid maintenance. Our client has a very large subsidiary in the Northwest, United States. They do the data center MRO. They do solar maintenance or repair. They install the big what they call inside the fence substation stuff. But we bumped into a small little company that they had a very express interest in. It was maybe $10 million in revenue, and it was a relatively new business. But they had a LiDAR application that they used actual helicopters for. Probably will evolve to drones, but they can go down the line. You think about how long some of these lines are, especially mid-America, flyover states or whatever. They just go on forever, and this can quickly fly over and say, there's a power glitch here. There's a need for maintenance here, and so our client was like, their eyes are like this big, going, oh my God, this is something we don't do, and it's really cool, and it's necessary, and it saves a lot of time, and so I think maybe you just got to use that sort of first mover advantage when you're in a business like that. That's very, very, industry and or customer centric.
Yeah. I do find that on the sell side, a lot of it is understanding why buyers are buying, right? And if you can figure out like what is it they're really trying to achieve? Is it just financial? Are they trying to round out a portfolio? Are they trying to get access to a certain customer? Or they want geographic presence or something like that? Like that is where you can kind of really juice deals or like kind of get deals done if you can really understand the buyer motivation around this.
100%.
Let's talk a little bit about valuation, or just kind of what factors go into the valuation process. My kind of general thinking or approach to this is that there's always a valuation range, and the question is based on the nature of your business, how well run you are, some of these factors we've been talking about. Like, are you going to skew on the higher side of that range, or you're going to get pushed down to the lower side of that range? But how are you, like when you look at advising buyers, how are you setting kind of valuation ranges, expectation, or when you're kind of looking at companies, like how do you kind of create that gamut, that spread, and then how do you evaluate companies on where they might fall on that?
Well, it's funny, and this is no surprise to you, I know, but every investment banker thinks that they have like the secret sauce, but the secret sauce consists of three components that everybody has, which is traits, comps, and discounted cash flows will give you the valuation, right? So, and I think if people in our industry don't see that is kind of a dinosaur, that's gonna not necessarily the way things are valued, but the way things get to a valuation, right? The man hours that goes into it. Versus, I guarantee you, somebody's already got an AI program that'll do a DCF in a nanosecond, right?
Yeah.
And so, I think it's a great question. I think it's always a bit of a discussion, I mean, with sellers. I don't know. I haven't met a seller yet that doesn't think their business is worth more than what the valuation.
That's what you want to pay.
And so,
something's wrong if that's the case.
I've been in that position. I'm like, you're telling me I think it's worth 12. Well, you think it's worth 4? All right. So there's a lot of the dark arts in that stuff. But generally, most of the businesses we deal with, we end up sort of filtering through are pretty well run.
Yeah. Clay, this has been a pleasure. We're going to hit time here. I'm just curious, any other kind of piece of advice or suggestions you give to founders in terms of, as they're thinking about exits or preparing for exits, things that one or two things you think they really should do in terms of getting themselves prepared for this kind of transaction?
Yeah, I think, begin with the end in mind, right? And every entrepreneur is, you have to have that balance, right? But I think you got to believe that you're going to succeed, and I think you need to start from day one thinking, there's going to be at least a 2 or 3 year look back on all my books. Keep the personal expenses personal, keep the business expenses business. File your taxes, do whatever you can to be as this owner said to me, QV ready, right? And for those of us who don't know what QV is, means quality of earnings, which is one of the diligence processes that goes on when a company is going to be acquired, right? And so it's a verification, a rubber stamp by CPAs that say this is, these earnings that they're reporting as a private company are true and verified to the best of our knowledge. So I think it's just, just understand that, that when you're getting it, specifically if you're going to sell to a private, to a financial sponsor, private equity, I mean, those guys live in the financials, right? So you just run them as best practice as you can, I guess, and have fun and be glad you're not working for somebody else. I mean, that would be the other, advice.
Exactly. Cool. Clay, this has been a pleasure. If people want to find out more about you, more about the work that you're doing, what's the best way to get that information?
Sure. So my email address is CRISHER at TrueNorthCP, like Capital Partners.com. And my mobile is 914-426-1109. Unless you have a lot of crazies on this show, Bruce, then my office.
No, we filter out all the crazies. Only real
deals. You got the AI app for that? Filter the crazies?
Yeah, exactly.
Okay. Cool. Sorry.
This is great. No, that's fine. Thanks, Clay. This has been a pleasure, and some really great takeaways from. It's always fun to talk about from the M&A side and the buy side, kind of get the insights, because I think founders, like I said in the beginning, this is the first time they're doing it, right? And the other side is often doing this, multiple times a week. So it's really helpful insights. I really appreciate your time today.
Yeah, no, and I really enjoyed it, and always like talking to you, Bruce. So anytime you get bored, man, give me a call.
Thanks, Clay.
See you, Bruce.
All right, give me a second here. Let me get our recording